Turkish Airlines presents Business Africa.
Hello and welcome to this brand new episode of Business Africa. My name is Ronald Katop. This week, policymakers want a new future for African mining as the global energy transition gathers pace. This year's African Mining Indaba also sounded a call for local banks to get involved where international lenders are being too cautious. Plus, high interest rates place African borrowers in a fiscal bind for a third year running. Squeezed by higher debt service costs and growing debt, African governments are running out of financing options. And it is bittersweet in Tanzania as sugar prices skyrocket, with authorities blaming cartels for creating an artificial shortage. They say a plan is in place to ramp up imports in order to bring prices down. Stay with us for the details. Thank you for joining us. Africa's untapped mineral wealth is worth trillions of dollars, but the continent received less than 10% of the global average spent on mining exploration in 2022. This is often the case because investors struggle to convince international lenders to commit money to African projects as they are considered too risky. At this year's Mining Indaba, local financial institutions were called upon to bank more on mining.
The 2024 African Mining Indaba called for a bold and new future for the industry on the continent. This represents a shared aspiration by countries to have more say in how their materials are exploited. By renegotiating mining agreements to demand more in taxes, royalties and profits, or banning the export of unprocessed minerals, African countries are attempting to create a new and more fair mining order. But whether this can be achieved without jolting the confidence of investors remains to be seen. Despite being home to as much as 30% of the world's mineral reserves, in 2022, Africa accounted for less than 10% of global mining exploration spending and less than 5% of the sector's global revenue. With vast reserves of critical minerals such as cobalt, copper and lithium, interest in African mining has ticked up as the world races to secure materials needed to achieve decarbonization. Experts are optimistic that interest will be followed by larger capital commitments. The Indaba challenged African banks to increase their role by stepping in to provide cash to projects considered too risky or expensive by international investors and lenders.
Celesta Mukeba Montwabo is the managing director at EquityBCDC, the second largest bank in the DR Congo. Thank you very much, sir, for your time. Mining is one of the biggest drivers of growth in the DRC. How is your bank supporting this crucial sector of the economy?
You know, EquityBCDC operates in the DRC for centuries now. So we have a very huge and long experience to supporting development of mining operations in the DRC with all type of product and services. Above that, we really support as well the entire value chain of mine with the financing, appropriate financing instrument, which we could put to all the operators who are around the mining SME, the entire value chains with really top-notch services that we are offering and providing. So in that way, we are really the key reference bank operating in DRC and really supporting the mining industry. As you know, mining sector is big and the DRC is really playing a key role with strategic minerals.
Artisanal miners, often ignored but crucially important. How is your bank supporting engaging with small-scale miners to help them scale up production and productivity?
We have social and economic engines. So under the social engine, we do run entrepreneurship program toward artisan miners, and we do financial literacy program, financial education, so that they can understand better how they could manage their companies. And with other development agencies like USAID, we are really working together hand in hand to really support those artisan miners.
Let's talk about critical minerals. They are abundant in Africa, and African leaders now beginning to restrict the exports of raw ore in favor of local processing. How is EquityBCDC supporting efforts to develop local value chains for batteries and electric cars?
Thank you very much. I mean, there is a lot of initiative and a lot of conversation going on really exploiting the strategic mineral and really creating value and value addition in the home countries. We follow closely what is happening, for example, in between Zambia and DRC agreement, and we look at the development of Lobito port. So we are really in the center of the conversation to really see what we could do as a banking industry to support those initiatives.
Investors want more from their mines, reduce risk, and governments are demanding more from their minerals and metals. What is your bank's value proposition?
On our African resilience and recovery plan, one of the pillar number one is really to look at the primary sector, which is agriculture and extractives. So this is what justifies our presence in Indaba, that we would like really to be the partner near the mining houses to be able to support them. But it is a very inclusive model that we will bring on the table, which covers mining houses, their value chain, and as well to look at the social impact that they would like to create.
Mr. Muntwabu, thank you very much for your time.
You're welcome. Thanks.
Interest rates are projected to stay high in 2024, placing further strain on African borrowers already spending around 23% of their export revenues to repay external debt. Away from facing higher borrowing costs, governments are struggling to access new credit as private lenders pull capital away from developing countries.
As interest rates remain largely unchanged from 2022, developing countries are staring at another year of difficulty in accessing development finance in 2024. With most of their debt denominated in dollars, African countries are facing a double whammy of higher debt service costs and difficulty to access new credit. A new report by the United Nations Conference on Trade and Development says about 3.3 billion people, almost half of humanity, now live in countries that spend more money paying interest on their debts than on education or health.
The reality is that African countries pay much larger interest rates than other countries. In fact, a study in 2015 found that African countries were paying 2.9% more on bonds compared to other countries. And reasons that we're seeing African borrowers paying such higher interest rates is due to the World Bank and IMF's debt sustainability analysis, which essentially monitors countries' debt levels. And when that happens, it makes access to private finance much more expensive. It creates this illusion that investing in African countries is riskier, and this results in an African risk premium where borrowing becomes more expensive and African countries struggle to secure new financing that they very much need.
Experts say that high interest rates could dampen otherwise brightening growth prospects for countries such as Ivory Coast, Ethiopia, Kenya and South Africa, all of whom have Eurobonds coming due this year. Despite success by African central banks against inflation, high interest rates continue to drive up debt and put a squeeze of public spending in economies that have barely made it out of the COVID-19 pandemic.
Now, Tanzania's sugar regulators are seeking to ramp up the availability of the sweetener amid a nationwide shortage. The government has approved the importation of 100,000 tons of the product. A plan is also out to scale up local sugar production by next year.
A shortage of sugar has left Tanzanians with a bitter experience. Prices have surged from under $1 in November to as high as $2.50 a kilogram. The government wants to cap prices at $1.27 and increase imports, but producers say it will force them out of business.
The Ministry of Agriculture has issued permits to business people, including manufacturers of sugar, to import more than 100,000 tons of sugar. This exercise is currently underway, and what we know is that the sugar has already arrived.
Despite reassuring statements from authorities, regular consumers of sugar argue that things have not yet returned to normal.
The price of sugar is still almost double, and its availability is also a challenge. It's very scarce now. Different shops sell it at different prices. No standard price yet.
The government attributes the sugar scarcity to cartels, which allegedly are hoarding and price-setting the commodity. Additionally, the government says El Niño rains have impacted national sugar production. Currently, Tanzania's 7 sugar factories produce 1,000 tons of sugar daily, falling short of the national demand of 1,500 tons per day.
Daniel Kijo, Dar es Salaam.
And that wraps up this episode of Business Africa. With me, Ronald Kato. The news continues on air and online. Bye for now, and I'll see you on the next episode of Business Africa.
Business Africa was presented by Turkish Airlines.